Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 316 of the Independent Advisors Podcast. On today's show, we are covering a few timely and important topics, including a stock seasonality update, several interesting charts that tell us about the underlying health of the markets and the economy, more stock buyback data, an update on the housing market, and an important update to the Federal Reserve's priorities. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So let's jump in. How are you this morning, Matthew?
I'm doing good, Mark. I have an interesting observation about the market over the past week.
Sure.
So on Tuesday, the day right after Labor Day, market was relatively weak relative to the last couple of weeks. Narratives on financial news media is sky is falling. We told you this is going to happen. It's going to get a lot worse. Then we get to the next day, Wednesday. Market rallies. We told you yesterday to buy that dip. And the hypocrisy of how fast the headlines move to adhere to the clickbait lately is just like, it's grinding my gears a little bit.
Yeah. Yeah, that's there's been a lot of that out there lately. A lot of Monday morning quarterbacks.
Oh, yeah. You got to tune it out as much as you can.
You do. Yeah. So it's been a little bit of a flip-floppy type of week. So yesterday, Apple and Google seemed to prop up some of the major indices. Mm-hmm. Not a recommendation for or against, but a judge, I think, ruled on Google not being able to pay to be the preferred search provider on phones, but kind of restrained from any harsher action than that. So I think Google was up something like 9% yesterday. Yeah. And I think Apple was up 3 or 3.5% or something like that. Yeah. So I think though, the weighting of those names in the indices, I think made the performance look a little bit better than maybe the underlying strength is. But yeah, it's no secret, and we're going to get into this here in a little bit, that we're kind of going through the weakest period of the year for stocks.
Sure.
So you are going to get, like you mentioned, a lot of that fear mongering, I think, at this point in the calendar. So
yep, well said.
Talking about performance of the major indices that we track, this data is from Y Charts and as of the market close on September 3rd. S&P 500 index down 0.2% so far during September, but up 9.6 year to date. The Dow Jones Industrial Average down 0.6% for the month and up 6.4% for the year. The NASDAQ Composite Index down 0.2% for the month and up 11.3% for the year. The Russell 2000 Small Cap Index down 0.6% for the month and up 5.8% for the year. And the Vanguard All World X United States ETF down 0.5% for the month and up 20.3% for the year. 3-month Treasury rate at 4.18%, 2-year Treasury rate at 3.61%, and the 10-year rate at 4.22%.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Moving on to big headlines and current events from the past week. Revised data for Q2 GDP was released on August 28th. revising annualized economic growth from 3% up to 3.3% in Q2 for 2025. Expectations were for a revision of up to 3.1%. So this is the strongest quarterly growth since Q2 of 2023. And the report was driven by strengthening exports and gross domestic investment. Anything else you want to add to that?
All I'm going to say is that's not bearish.
Yeah, that's a great point. Moving on to tweets, articles, and research from this past week. First thing I had, Matt, was a post on X from our friend Ryan Dietrich at Carson Investment Research. This was back on August 29th. Like I touched on earlier, Matt, it's no secret that we are in a weak point in the calendar. So Ryan posted on X and said, yes, stocks gained this August. Still, here's a way to show just how weak September has been. September is the worst month since 1950. It's the worst month over the past 10 years, the past 20 years, and the third worst month in a post-election year. In fact, August and September have both been higher in a post-election year only 3 out of 18 times.
That's not odds I want.
No, it's not. It's not odds that we want. So I think it's just important to be aware of this information. I don't think that this means that investors need to go and sell everything right now. This could be 2025, could be 4 out of 19 times in a post-election year where the markets have been positive both in August and September. So we don't want to make investment decisions purely based on seasonality, but I do think it's important to understand where we are in the calendar, in addition to the fact that we really haven't had much of a pullback since the April low.
I'll take the other side of this. Let's say that you're a listener or a viewer of this podcast and you've been underweight equities since April 7th market bottom. You might get some pitches. Now, whether you're going to take some swings at bat, I can't answer that for you.
Right.
But you can't come to me on December 31st and tell me you didn't have some opportunities.
Yeah, and I think, I'm not afraid to say that, if we do get some sort of a correction or some sort of sell-off this month, I think that we would, unless something drastically changes, we would probably be buyers of that, knowing that Q4 is usually pretty strong. Post-election years tend to be pretty average. So, S&P 500's up around 9% so far this year. If we get a pullback to where it's up 2 or 3%, I like the odds that the market rallies, after that correction into the end of the year.
Well said. Nothing to add on that.
Next thing was kind of an add-on to my first piece. So this was a blog post from Jeff Hirsch on August 27th, just to kind of add some more data towards the weak point in the year that we're at. He says since 1950, September has been the worst performing month of the year for the Dow Jones Industrial Average and the S&P 500. More recently, the Dow, S&P 500, NASDAQ, Russell 1000, and Russell 2000 have been down 7 of the last 11 Septembers and 4 out of the last 5. In post-election years, September's overall rank improves modestly going back to 1953 to be the 3rd or 4th worst month, depending on the index. And the Dow Jones Industrial Average and S&P 500 have declined in 10 of the last 18 post-election year Septembers. So a lot of similar stats to what Ryan said, but a couple more pieces just to back it up. But then kind of the contrarian me is like, I'm seeing so much of this that like September's so weak that maybe it'll end up being a decent September this year, because usually we don't see this to this magnitude. But, we saw the same thing going into August, right? We were like, hey, in post-election years, August tends to be weak, and that August, mid to late August is when markets start to get a little jittery, and that's happened over the past couple of years, and August was a great month for stocks. So
I love how you've been talking about seasonality for years on this podcast, and now all of a sudden it's like the in vogue topic.
It is. Just because something has happened in the past doesn't mean it has to happen in the future.
There you go, man.
The last thing I had was a blog post from Taylor Schulte on August 28th titled 6 Favorite Investing Charts. So he plucked a bunch of charts from January through August that has kind of shown what 2025 has been like so far. I just wanted to highlight a couple of the charts that Taylor discussed in this blog post. I do recommend people go check out his article because there are more great charts in there.
Great.
So the first thing, something that you've mentioned several times over the past couple of months, Matt, was U.S. stock buybacks. So companies are buying back their stock at a record pace. He says corporate buybacks are surging. So far this year,
And surging is properly used in that sentence.
It is. I would agree. So far this year, U.S. companies have announced nearly $1 trillion in report purchases, and they're on track to exceed $1.1 trillion by year end, setting a new record. When a company buys back its own shares, it reduces the total number of shares outstanding. That means that each remaining share, ours included, represents a slightly larger ownership stake, and with it, a larger claim on future earnings.
Bingo bongo.
Anything to add?
I think it's underreported. I think this is one of those topics that's not getting enough headlines.
Yeah, I would agree. Number two is as the dollar moves, so do equity markets. While no one can predict the future, one relationship that has held up remarkably well over time is the direction of the U.S. dollar often aligns with shifts in relative equity performance. A stronger dollar has typically been associated with outperformance by U.S. equities, while a weaker dollar has often favored international stocks. Currencies, just like all financial markets, are notoriously difficult to forecast, but history suggests that wherever the dollar heads next, equity leadership may shift in response. And I think this has been the story all year so far in 2025, Matt. We've had a very, very weak dollar.
Yep.
And in turn, you've seen international equity outperformance for the first time in quite some time.
Well said.
Now, I think the interesting thing that we've went back and forth on several times this year is it going to last this time? Is this a long-term decade turnaround? Or is this just a one-off year like we've seen in the past as well?
I have a very harsh and critical reaction to when I hear this. You're not going to outperform the U.S. when you're working 32 hours a week and you have slow growth in your top and bottom line of your income statement. Mm-hmm. It's just the odds are against you.
Yeah, I would agree. I
mean, I know it's harsh to say it that way, but that's the reality.
Right. And I think that there's a lot of people, or we've heard for a long time now over the past, really, it's getting close to 10 years. I remember when I was saying this was like 3 to 4 years or 4 to 5 years, but now we're getting on 10 years. Everyone's like, at some point, international stocks are going to outperform U.S. stocks over the long term. At some point.
Sure. And
that still might be true, but it hasn't happened yet.
I think you're going to go through these bouts of short-term but drastic outperformance by international, and people start loading up on them, and then people then wake up one day and realize that the balance sheets aren't as good and the growth rates aren't as good, and they're going to think to themselves, "Why did I do that?"
Yeah, very possible. Very possible. Last thing I had was, or the last thing that Taylor wanted to point out was a chart on household debt service and how it remains historically low. So he says, even with higher mortgage rates and rising loan balances, the average household debt payments remain below historical norms.
This is a good chart, Mark.
It is. I enjoyed this one. So he said today, mortgages make up about 70% of total household debt, yet overall debt service, which is the percentage of income spent on debt payments,
yes, sir,
is still relatively modest. While some delinquency rates have begun to rise, most consumers appear to be managing their debt effectively, suggesting a generally healthy financial backdrop for the near future. It's no surprise that we are not fans of people reporting data that just shows overall household debt in the U.S. when it's not compared on a relative basis. But I think this puts it in a more fair and accurate light.
I like this chart a lot.
Yeah.
I like
so
this.
check out the full article if you can. It'll be on our show notes. And I will turn it over to you. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Oh, great job this week. I love your content. So I have a little bit a redundancy for our newer listeners and viewers. Mark and I don't tend to review each other's notes. So there are some times where you get a double dose of the same topic in the same podcast, and you're getting that today. So my first piece was about some of this stock buyback data, Mark. And the timestamp on this is August 20th, and it's from Bernini and Associates. What they were talking about is so far, what you'd mentioned a couple minutes ago from Taylor's chart, 1 trillion of stock buybacks announced so far this year. They named some iconic companies. These are not recommendations for or against any of these, but just to throw them out there: Apple, 100 billion, Nvidia, 60 billion, Alphabet, which is Google, 40 billion, and the following are all over 40 billion apiece: JP, Goldman, Wells Fargo, Bank of America. And, again, as you said, I hate to sound like a broken record, but these were my prepared notes. Why is this crucial? Buybacks act as a buyer of last resort, mechanically supporting these stock prices. They reflect the strength of profits, enough cash to invest and reward shareholders. So I won't hit that any further. But again, the reason I selected it is I feel it's not being reported enough in the mainstream news media. Let's switch gears. I want to talk about home prices, okay? Now, why is this a topic that I've selected for our listeners and viewers? It has to do with consumer confidence, right? We've seen a huge gain in property prices since the pandemic. So let's just put a timestamp on it of the last 5 years, okay? We haven't seen decreases nationwide, for the most part, since then. Starting to see some cracks in the foundation. So this is a chart that caught my eye. What it talks about is the estimated number of U.S. home buyers and sellers actively in the housing market. And the underlying source here is Redfin. We've noted some of their housing and real estate related data over the last couple of years. And what you're going to notice here is it says, and I quote, Redfin says, in June 2025, there were 508,000 more U.S. home sellers than home buyers. And it's a graphical representation that goes back over a decade. And my point is this: any point in time when you are selling a good or a service and you have such a flip-flopped imbalance such as this, it's hard to think that prices aren't going to be hurt because of it.
Right.
So I'll be curious to see over the next, say, 6 to 12 months, how the Federal Reserve adjusts interest rates. I am concerned that the longer end of the curve, meaning longer dated debt, 10, 15, 20, 30 years, might not come down as quick as people think. If it did, that's great for housing prices, right? Because affordability. But this is definitely one of those data points in housing that's pointing to some headwinds. I just want to throw it out there. Your thoughts?
Yeah, for sure. And I think, people in the market to buy a home will be tickled by this, because especially first-time home buyers, because they feel like they've drawn the short end of the stick for the past 5 years on this.
They have, right?
But not great for sellers. And again, it's just that simple law of supply and demand, right? If you have a lot of supply but not a whole lot of demand, then prices should come down. And might be not so good news for Jerry and Sue McEvely, as they're getting ready to sell their home in Rochester next week. So maybe they'll get it on the market before the pricing hit really comes.
Oh, Jerry and Sue.
It's one of those things, and it really is a timing thing, right?
It is.
Like I always tell people, when Kenzie and I bought the house that we're in right now, the timing was just perfect. It was like right before the Fed started to raise rates. We got a super low mortgage rate. The house that we sold for more than what we could ever imagine. It was just a good timing thing, right?
Yeah.
But if there's people that get lucky during good times, there's going to be some people that get shafted during bad times, right?
Yeah.
So you can't really plan. Let me say it this way. People don't sell their house or buy their house to take advantage of the environment that we're in. They're selling or buying for a reason for their family. Right?
I agree with this. Keep going with this, because I want people to hear this.
Yeah, they're moving, or they get a job in another state, or they're downsizing. It's not the housing market that's making them make a transaction.
Correct.
It's something in their personal, professional life, a life event that makes that happen.
Well said. And anytime a client calls me up, this is an important point, and says, hey, I'm thinking about doing this XYZ housing transaction, upsizing, downsizing, etc. Matt, what do you think? Hey, if this is something that you're going to be in for a very long time, don't try to time that. If you're looking at this through the lens of an investment, tread lightly, because what happens is, the more it feels the transaction's investment related, the time horizon that client has is always shorter. Did you pick up on that too?
Yeah, for sure. And I've run into situations where people have tried to look at it as an investment and time it, where they think they're going to come out ahead money-wise. Mm-hmm. And then it turns out they don't come out ahead money-wise, and then their quality of life is decreased because they're moving into a house that doesn't fit their needs or is smaller than what they had.
Or it's stretched on the payment, and they're kind of house poor.
Right. So, it's just a hard thing to do.
Love that feedback.
Yeah.
We're yinging and yanging right now, buddy. So my next thing is about the Fed. And this is my last topic before you do the financial planning topic of the week, Mark. This topic is not getting enough attention. I don't understand why. And this is part of my gripe right now with the media over the past couple of weeks. If you can sense the undertone, it's this right here. This should be plastered on the front of every website the last couple of weeks. So here it is. Powell said the Fed has adopted a new framework that removes a reference to the central bank seeking inflation that averages 2% over time and to it making decisions on employment based on shortfalls from its maximum level. Wow. I saw that. The first thing I did is I texted Mark McEvely.
Yeah, it's one of those things that has been, they've been pounding the table on this, 2% inflation target for a long time. And now, at least from my understanding of this, Matt, tell me if I'm wrong, now they're going to put more of an emphasis on employment and that relative to the maximum employment level that they're seeking.
Yes, and let me tell you why I think they're doing this. I think they're doing this because the pain the economy would have to endure. Right now, I could argue that we're averaging inflation, the consumer price index, the government's index of inflation, we're probably around the 3% range. The pain that the economy would have to endure to go from 3 to 2 would be, I think, substantial. And I think they realized we just got to remove that piece of it. Let's focus on full employment. 3's not bad, and let's move on with life. That is my paraphrase attitude on how they're handling this. I like it. I know that might be a hot take. I might look back on this comment in 5 to 10 years and be like, why did they say that? They should have stuck with the 2. But from an economic standpoint, I'm not against this. What's your initial raw thoughts?
Yeah, I guess I don't really have one way or another. I think, just on what I know about the markets, it's like, okay, we're gonna forget about the 2% target, and 2 years from now or a year from now, we're gonna look back and we're at 2% after they forgot about about that or dropped that, right?
Yeah.
And then we're gonna have an employment issue because that's what they're focusing on. So that wouldn't surprise me either. But I think it's going to be interesting to see what we get before the end of the year. I think it's, all but certain that we're going to get a cut here in a couple of weeks. I think their next meeting is September 18th. Okay, that'll be one cut between now and the end of the year, and the first cut since December of 2024. So the first cut in almost a year. It'll be interesting to see if they do any more before the end of the year or if they wait again. I think this is the best possible scenario for stock investors because, like we've put data out there on the podcast before, the slower the rate cut cycle, the better. And I would categorize us not having a cut since December of 2024 a pretty slow cycle.
Yeah, I would argue with that. And then, what about that 7.4 plus trillion sitting in money market funds that's, happy and cozy with their blankie at 4.1%? And what happens, I can tell you right now, short-term rates are going to take the elevator down. I'll tell you that right now.
Yeah.
And so, when that goes sub 4, how's that money going to act?
Yeah. Yeah, it's a great point.
Right?
It's a great point. Okay, so last but not least, financial planning topic of the week. This was a blog post from Seth Klarman on August 25th titled Job Churn. So this week I wanted to go in a bit of a different direction for this segment. And over the past few years, it's obviously no secret that AI has seen a dramatic rise in uses, advances, et cetera. And a lot of people are worried that it's going to replace every human worker out there, right?
Oh, okay. Go. All right. I'm following you.
So I wanted to share a few lines from Seth's blog post that really puts this into perspective.
Okay.
So he says, since I was born, humans have created 6 billion jobs, all while technology relentlessly disrupts existing industries. The pin making machine replaced the handcrafted pin. The ox pulled plow replaced millions of hours of backbreaking work. The amplification of electronic distribution of music upended the work of the live musician, and the camera replaced countless portrait artists. The internet destroyed the travel agent industry, and Grammarly and Photoshop turned fine editing jobs into low-paid gig work. The assembly line replaced skilled craftsmen who built entire products by hand. The printing press eliminated armies of scribes who copied books and documents manually. The automobile industry wiped out blacksmiths, stable hands, and carriage makers. He goes on, but I think you get the point, right?
Yeah, I think this is good. Keep going.
So he says, it's entirely possible that a magical AI will replace every single human job and then destroy the earth, but it's far more likely that the pattern of the last 500 years will continue. If this transformation was an opportunity, what would you do with it? So we've talked about this a little bit before, but this isn't the first time we've gone through a huge technological advance in this country or just in the world in general, right?
Sure.
And I think the fears are overblown. And the reason why I put this into this financial planning segment of the show is, I've had clients with conversations like this have come up where they're like, hey, I don't know if I'm going to have my job in the next couple of years because I think AI is going to advance to a point where my company's not going to need me anymore. And I go back to this blog post that Seth put out there, and we've been through this song and dance before, and every technological advancement at the time seems like the biggest greatest thing ever, and
Sure.
that it's going to wipe out entire industries and entire economies, right? And people in the workforce. So I'm not saying it's not going to happen, but if I were a betting man, I would vote on the side of history over the past 500 years, and we are going to continue to evolve technologically and get more advanced, but I don't think it's going to replace every single human worker.
No, I don't think so either. And, let's take the American economy as an example. The services side of the American economy has grown a lot over the past decade. Now, the current administration's putting forth policies to reinvigorate the industrial production side of the American economy. But addressing the services economy, a lot of that's going to stay person to person. It just is. I have an interesting kind of thought as you were talking about this. It made me think of a research piece I saw yesterday from Mike Zaccardi that actually pointed out, Mark, that wage growth right now for people staying at their job is higher than for job switchers for the first time in years. I know it's not completely translated to the AI side of what you're saying, but just looking at the jobs market right now, I don't think it's horrible. Yeah, it's definitely softened up over the past year. I don't think it's horrible by any means. So I think it's an interesting point that you bring up, though, that the technological innovation, especially with how fierce the AI trend has been, it could be unsettling.
Yeah, for sure. So I just wanted to throw that out there. With Taylor not on the show this week, I thought it was an interesting thought experiment. So
yeah, that was good.
Anything else before we leave it off there for the week?
No, we talked about the unseasonable, period that we're in. September. We got the Fed meeting in a couple of weeks. I just wouldn't be surprised if the market was kind of in its own version of no man's land for the next couple of weeks. Wouldn't surprise me.
No, I would agree. Well, thanks everyone for tuning in and listening to episode 316 of the Independent Advisors Podcast. We will be back with you next week for episode 317.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.